I turned $500 and grew it to 5,000 trading stocks every day. Today, I'm giving you the exact playbook and why it works. Most people purchase courses and follow ridiculous technical analysis patterns hoping to make some money. I'll tell you now that you may as well get on your knees and ask God for which stocks to pick. This strategy I'm about to introduce to you actually works, and if you don't believe me, instead of just showing you a bunch of indicators and nitpicking the rare stocks that this had worked on in the past, I will explain why this strategy works in detail. On top of that, this strategy is used by actual investment bankers, not YouTube day traders guaranteeing millions overnight. The strategy I used is called the scalping strategy. Here is the step-by-step. First off, this strategy only applies to high-volume stocks. We're talking Tesla, Walmart, Nvidia. The idea is that we want to trade stocks that have frequent movements in the market, and are high volume enough such that individual trader trades won't affect the price. We want to be able to read pure market sentiment, not random noise. To be honest, the actual stock we use doesn't matter, so long as it's high volume. You can look for these stocks by going through Yahoo Finance and filtering your search base to show only high volume stocks. Second, set up your trading view such that you trade on the 1-day time frame, and set the candlestick intervals to 1 minute. Now that's the setup. We'll be using 3 indicators. The first two are the 10-period moving average and the 34-period moving average. The 10-period moving average shows us recent price changes, while the 34-period moving average shows us the broader short-term trend. What does this mean for picking our position? When the 10-period crosses over with the 34-period in an upward trend, you should buy the stock expecting growth, as this crossover suggests strong buying pressure. If the 10-period crosses over in a downward trend, however, short the stock. Let's look at an example. Here we can see the Walmart stock. Notice how in every instance in which the 10-period crosses over the 34-period in an upward trend, the price of the stock climbs shortly after. Now the same can be said about the downward trend. Short the stock after seeing this, you make money. But be careful, this does not happen all the time, not unless we use the third indicator, the Relative Strength Index, or the RSI. This indicator measures the speed and magnitude of recent price changes. It essentially tells us whether a stock's demand is too high or if it is oversold, and acts as a filter to detect strong and weak crossover signals. In summary, the moving average crossover tells us when a trend in a stock's price has changed. The RSI will then tell us why the stock's price will change in terms of demand and supply volume. Now, back to our trading view. Add the RSI indicator and set 2 markets, RSI 25 and RSI 75. When the RSI line is closer to 25, that indicates that the stock market is oversold. This means that when the 10-period moving average next crosses with the 34-period moving average in an upward trend, an increase in price is extremely likely. If the RSI, however, is closer to 75, it means that the stock is overbought and signals a short position the next time the 10-period line intersects with the 34-period line in a downwards trajectory. Despite this, you would be foolish to think that this would work 100% of the time. If this were the case, then why isn't everyone just using this? When I did this, I had won about 60 to 65% of the time. Granted, this can be improved through years in the market and extreme intuition. Due to this win rate, I followed a 1% stop loss for both profits and losses. By making 1% movements and being predictable 65% of the time, in the long run I make profit that compounds.